All right, everyone, welcome to the Tower quarterly video, the quarter in review. It's Mark and Tarek here. Just wanted to start this video by going over a little bit of the returns in the portfolios and the market in general for the last 6 months, year to date to the end of June. So as many of you know, it's been a challenging, 6 months with the TSX. It's down 9.87%. The S&P 500, that's the biggest 500 companies in the United States, down roughly 20%. The NASDAQ composite down 29.5. The NASDAQ encompasses mostly tech companies. And then the FTSE 250, that's the London Stock Exchange, down 19.4. So it's been a very, very challenging first 6 months, a year to date.
And we should obviously mention that Bitcoin is down. I think it was 54% there.
Exactly. Bitcoin's in the tank right now as well. Everything's kind of down. Now, in light of that, I do also want to mention our returns in our portfolios. Okay, so Canadian Momentum, it is up year to date 3.9%. If you're in that strategy, our express goal is to beat the TSX, which I mentioned is down 9.87. So quite happy with the returns there. Enhanced index strategies and aggressive growth, we're down 7.35%, all the way down to conservative, where we're down 8.72.
So the question is, why is the conservative the worst performing?
Good question, Mark. And we've mentioned this a couple of times. The reason is the conservative portfolio is primarily bonds. It's 65% bonds. And this market that we're in is very, very hostile to bonds. Rates are going up, bond prices are going down. And that's why we've been saying to many of our clients, to many of you, reduce the bond portion of your portfolio. And that's why the conservative portfolio has done slightly worse than the enhanced index, the aggressive growth. That's what I meant there. So, tough 6 months in the market. Now, we've gotten some questions from you.
All of the portfolios have outperformed the TSX, not to mention the S&P and FTSE. And the S&P and FTSE are parts of our enhanced index.
Absolutely, the enhanced index does go across all those markets, and so
let me add this. I think the reason that our enhanced index are performing relatively, well, down but not down as much, is because they're fundamental indexes. They own companies weighted by the fundamentals of each company. We can unpack that more with you personally if you like. We repeated a bit of it from last time, so we're not going to chew that cabbage again. But nonetheless, that's probably why, when a market starts to correct, it's the bubble stocks that take the big correction. Ours are not the bubble stocks. Bubble stocks outperform in the run, and then they outperform on the downside. They crash harder. So anyway, back to you, Tarek, or is it my turn?
Well, actually, that's a really good point. I think that's exactly why our indexes have performed better. The big question is now, though, we're halfway through the year, and it's what comes next. A lot of our clients have been asking, do I go to cash? Do I keep my cash on the sidelines? Is there a recession coming? And I will turn it to you to maybe speak to at least one or two of those questions. What do you think?
Sure. Tarek and I got a question from one of the clients, hopefully one of you who's listening. I say thank you for the questions that a couple of you have sent in, and we want to have more, so feel free. But I wrote out an answer to this client. I'll not use his name at this point, but here's the first paragraph of the email I wrote him in the response to the question of, what do you think about a recession or going to cash right now? And he's not the only one asking. So I think the main point of the article is that we're heading toward a recession in all probability. With that, Tarek and I agree. In my mind, there is no way we can avoid 2 quarters of negative growth, which is the definition of a recession. Mm-hmm. In my opinion, that would be good for getting prices back into sane space, like prices of real estate and prices of gasoline and so on. In fact, the general markets are saying we are headed into a recession. And I would not be surprised if it comes in the second half of 22. Most economists are predicting actually it's in 23. I don't think so. I think it's coming more quickly. The main question is, will it last longer than 2 quarters and become a depression with a full correction of all prices? That's always possible. It's not likely, given the tools the governments have to stimulate the economy, if they see that happening. So I think the governments are now trying to set off, sort of a sprinkler system to get the economy to cool. But I don't think it's going to be a massive crash. If they see a massive crash coming, in the economy, they're going to just turn on the Bunsen burners and get things heated up again, which means they bring down rates. Now, let me do one more comment about the yield curve, and that is, for several years, the yield curve has been positively shaped, and that is near-term, short-term rates are lower than long-term rates. That's the normal shape of a yield curve. It is called the normal yield curve. And basically, over time, there's higher value for longer-term money. Now, more recently, this has happened. Short-term rates have risen so that the yield curve is inverted. Okay, the shape of the yield curve, this is simplistic, but it is true. The shape of the yield curve shows the direction of the economy. When it's shaped like this, the economy is growing. That's usually the midterm cycle or the mid part of an economic cycle. And then what happens is things get too heated up, and suddenly short-term rates rise to start cooling it off. That means the economy is heading toward a cooling down. That's the end of cycle happening, and it's the early cycle when that corrects and starts to take off again. We're in this position right now. The probability is interest rates are now about ready to start going down. Don't know when. You could say, okay, then I want to go back into bonds. Yep, that could be. I think I'd rather see you go into stocks, because as this comes down, stocks will also start to perform well. And the fundamental stocks will do, especially the early cycle stocks like banks and forest products, they will start to perform even better. And that's where in momentum, we can pick up those industries because they start to show positive signs earliest.
Yeah.
Okay, that's it on the economy and different parts of the cycle. There's an early part of the cycle, there's the midterm, and then there's the late cycle. We're probably late in the late cycle right now, in my opinion, about ready to start heading back toward this growth.
Yeah.
What am I missing?
Well, I think that was a good summary. I think the thing that needs to be also emphasized is that the stock market leads the economy, if you will. So
Good
the stock
point.
market started correcting, back in January, December. Now, it's June, and we've seen, as I've read out earlier, the things are looking for, and now the economy is likely going to head into that recessionary sort of place, and the stock market will start to move up again much sooner than the economy does. So that's the thing to be aware of. And in terms of, do I move to cash? What do I do if a recession is coming? We would say absolutely not. Don't move to cash. If you have cash on the sidelines, it might be time to put it in, because when the stock market starts to, yeah, exactly, averaging down or dollar cost averaging, when the cycle does start to go back up, the stock market will lead the economy. If you wait for the economy to be strong before you invest in the market, you'll have missed it. Right. And you don't want to get stuck in the timing of those sorts of things. It's not a game worth playing.
Yep. Let me do one more thing and then we can get off of here. Looking ahead, Tarek has bellied up to the bar, put his account into a new strategy that we're developing. And that is, how we've talked about our momentum strategy. Well, actually, it's a Canadian momentum strategy. And I think one of the clients at our Medicine Hat event suggested maybe we could do this on the S&P 500, because it really has performed remarkably well over a long time. So we've run the screens in the US market. We've done the short list, and Tarek has put his money in his account into that strategy so that we can test it with real money. And my guess is we're still a year away before we make it available to clients. But we're going to be testing it with real money, which is the right way to test a strategy.
Absolutely.
One other thing, if you're wanting to move around in your strategy, like maybe you've got a little too much conservative, you want a little more momentum, we would encourage you to think about it. We don't want to encourage you to do something that is unsuitable for you. So there is a right, appropriate mix for each client, and we're quite happy to tailor it to you. So if you'd like to, just give us a call. Last thing I want to say is our next call, we're thinking about making it live so we can have some Q&A with you. So that'll be a quarter from now. Until then, if you want to reach out and touch base with us.
Absolutely. And we'll send you some information on, how to join them on that call and, what questions we're going to answer. And so please stay tuned for that. If you do have any other questions about what we've talked about your own portfolio, about making any changes, always get in touch with us at the bottom of the email I just sent you. And we would love to chat. Hope you're all having a great summer. We'll maybe talk to you soon.
Thank you all. Bye-bye.